Kendall Trotter.
And I'm Steve Hawks.
Thanks for tuning in to this edition of the Las Vegas Real Estate Update. Today's edition is all about interest rates. I guess there's a big mystery out there about why people are calling us up and going, hey, why is my interest rate adjusting and it's going to be more when the rate may be lower. I've seen on TV that the Fed's lowered the interest rate time and time again, but now my arm is adjusting up. Why is that? Steve, is it maybe because when these people signed their loan documents, they didn't either read or didn't understand what the Libor index is?
Well, if their loan is tied to the Treasury index, their loan should be, their monthly payment will be lowering if it's tied to that. Unfortunately, 59% of all the ARMs are indexed based on the Libor index. And the Libor index is the London Interbank Offered Rate, which is set by a specific group of London banks, obviously in England, to...
So we're talking euro dollars here. We're not talking American dollars. We're talking
right.
Euro stuff here.
It's what the London banks charge other banks, and so it's set by the private industry. It's set by banks. It's not set by governments. That's one of the reasons why we're having this problem right now with loans not being able to. Congress wants to freeze loan rates. Well, if it's based on the Libor,
Congress has no control over it because they're in Europe.
Exactly. And so what the problem with the Libor is right now, the Fed is obviously lowering rates to, I think it's 2.5, 2.75 right now. So people are assuming their payments are going down, and they've been going through their savings and their credit to...
Waiting for that day that their payment's going to drop because they have an ARM, adjustable rate mortgage.
Right, and they've been told that their payment will drop. Well, it's not going to drop if it's based on the Libor. And like I said before, 59% of all ARMs are based on Libor, and almost 99% of the subprime loans were based on the Libor index. So to get a better idea what the Libor is probably going to do, it's almost 100% that it's going to go up in the next few months. The Libor, they have the 1-month Libor, the 3-month Libor, the 6-month Libor, and the 12-month Libor index. Most loans are based on the 6-month Libor index. And if you want to know what that rate is, it's usually in the Wall Street Journal every day. You can find what the rate is on the 1, 3, 6, and 12.
Right, so when your ARM adjusts, the day that your fixed rate ends, and it's time for your ARM to adjust, then the bank is going to look at what that rate is that day, and
that day that it's supposed to adjust, correct. They're going to look at, usually they're going to look at the 6-month index, but whatever your loan documents say, that's the index they're going to use. Another double whammy on this is most of the Libor indexed loans don't have a cap like the Treasury index ones. So a person's payment, most of the Treasury index loans have a 2% cap, which means they can only go up 2% from payment to payment. Well, the Libor doesn't. So your payment could actually double from one adjustment to the next. It could actually double. So that is going to be a big problem. And the reason why the Libor is probably going to go up, most likely, is because the Libor is set by private industry, set by banks, what the amount they're going to lend, the amount of money, the rate they're going to charge somebody, another bank, for overnight funds, or forever how long the maturity is. So right now, we obviously know that there's a credit crunch, and banks are, look at what happened to Bear Stearns. So it's a lot riskier now to lend money to another bank. Therefore, the Libor rate is going to go up because it's more riskier, so the bank wants a higher return on their risk, on their money.
Now, if I remember right, the last note that I read that was based on the Libor rate said, okay, after a certain amount of months, say 3 years, 3-1 ARM, whatever, it will adjust to the current Libor rate and then be good for maybe 6 months and then adjust again to the new Libor rate. So anybody that maybe this is happening to, your 3-year fixed rate has now adjusted, and you're going to adjust to the Libor rate, which obviously, like Steve just talked about, it's probably going to go up. However, you probably will be good at the new payment for 6 months to 12 months, depending on how your note reads. And you really need to read your note.
It's usually 6 months.
Usually 6 months.
Right.
But it, for anybody that's maybe falling, I guess, victim to this, I guess, because, you know,
if they're already behind and it's going to adjust, almost 100% chance, we'll do a 99% chance their payment is going to go way up, because, like I said, the LIBOR is based on risk, which is, it's a lot riskier for banks to lend other money right now, and it's inflation, and the governments don't control this rate. It's set by the free market, and we obviously know that inflation's going up and the free market's causing LIBOR to go up.
So, Steve, from what I'm getting, from what you're telling me, it's either time to refi or sell if you have.
Right, and the problem that they're having with LIBOR, they can't refi if there's no equity. So it's good information. People know what the LIBOR is, so now they can make an intelligent decision on this.
So here's your options, people. Your rate is either going to go up, or you need to refi, or you need to sell. I mean, that's where we're at right now, right, Steve? I think we're about out of time. We have to keep these at 10 minutes. I'm Kendall Trotter.
And I'm Steve Hawks.
Thanks for tuning in to this edition of the Las Vegas Real Estate Update.